Hey everyone, welcome back to Corporate Decoder. Today we are diving into Splash Beverage Group and their latest quarterly report. This one's a bit like a lukewarm soda, might have lost some fizz, or maybe the report will end with us needing an actual splash of cold water ourselves to wake up later. Splash Beverage Group is trying to build up beverage brands and they're hoping to get them out there with their own distribution system. So let's get into this report and see if we can figure out what's going on. Before we get started, if you like getting insights from these corporate reports, subscribe for more deep dives, and don't forget to join our Discord community linked in the description below for more discussion. First off, this is a Form 10Q. That means it's a quarterly report. We're looking at the period that ended in March of 2025. This is not an audit, so treat what it says with more caution. Alright, so Splash Beverage Group filed this report based on some rules from the Securities Exchange Act of 1934. Just noting this here too, they had a reverse stock split. It was a 1-for-40 reverse stock split that happened in March of 2025. Keep that in mind. Reverse stock splits are usually used to ensure the listing is in compliance with the exchange terms. As of July 11, 2025, about 1.9 million shares of common stock have been issued. Alright, let's jump into this financial document to explore some of the key highlights detailed within. Here's the financial health of Splash Beverage Group. This compares March 31, 2025 to December 31 the prior year. Accounts receivable net were about 173,000. Quite a drop compared to the previous period's 397,000. Inventory was 861,000, a slight decrease from the previous balance of 893,000. Property and equipment were about 168,000 compared to the previous balance of 205,000. Accounts payable and accruals were about 6.3 million. This is a bad sign, an increase relative to the previous 5.2 million balance. Related party payable remained consistent at 389,000. Notes payable overall are about 9.5 million compared to a previous 9.6 million. And the accumulated deficit, brace yourselves, it's a negative 159.5 million. This is worse than the previous 105.8 million. So looking at the amount of common stock, this all reflects that reverse stock split we talked about earlier. Here's where we see the profit and loss again comparing the 3 months. Net revenue, it's down. In the first 3 months of 25, they did about 438,000, a big drop when compared to 1.5 million in the first 3 months of the last year. Cost of goods sold also decreased, nearly $1 million between the periods to 469,000 against 1.4 million in the earlier period. The loss from continuing operations, a loss of about 2 million. So last year they lost 3.3 million, but this period they lost 2 million, much better than before. Now, interest expense, it's about 637,000 versus roughly 533,000. So those interest payments are hurting it for the company. Basic and dilutive loss per share. A loss of $1.97 a share, that's quite high. During the same period last year, their loss per share was 40.17. So to summarize at this moment, their income and revenue decreased, meaning they made less, and accumulated deficit increased, meaning they hold more debt. But despite that, the company has performed better compared to last year with a lower net loss compared to last year's filing. But is this true? Here's a great way to really track what a company is doing. Here is a statement of the changes in shareholder equity during this period with a review period of 2024. Looking at the first 3 months, the company did well with a total comprehensive loss against shareholder value. But some things to note are in the issuance of new items. They had 400 and 100 and 107,000 in stocks issued as results of debt. They also had 106,000 in share-based compensation. This means they are paying for salaries with their own stock, reducing ownership. Here we go through where is Flash's money going. Remember, this is not the same thing as profit. Cash flow is all about the money in and out. Cash paid for interest for paying interest on debts, they spent about 79,000. This is much higher compared to last year's 25,000 payment. Proceeds from the issuance of debt, they added 882,000 again. To compare, last year in that early slice of the year, they collected 465,000 more. Net cash in used operations is still negative, meaning that business activities are costing the company and not making them money. Here it sits at roughly 725,000 in expenses. To compare, last year it was roughly 1.3 million. However, non-cash debt discount in the form of equity is roughly 2.5 million, meaning that their equity is not worth what the debt is, and equity can only go up so much relative to other things. Okay, let's move into the document. There's something about a reverse stock split in March, just as a reminder. Nothing particularly jumps out under accounting practices. The biggest call will be in going concern and the ability of the company to remain viable over time and solvent. They go over levels to describe what they think something is worth. Something is considered level 1 if it has a direct price tag and not if its value is pulled indirectly or assumed. It's all how the firm estimates what things are worth. Splash Beverage changed how it accounts for debt with things like stocks and other incentives. Company books, when they sell something, pretty simple. Outbound shipping is paid for by the company, is classified as an administrative cost, so it will come out of the operational budget. They use common measurements to estimate price of stocks relative to stock options when issuing compensation. When they work out how much they are losing per share, stocks or stocks that may be used later aren't included. It makes things less diluted. Here's where things get very important. The company acknowledges it has had a history of losses. They had a 3.7 million loss in the past 3 months. They depend on additional funding to sustain itself. They gained a good lump of it through loans in the last quarter. They tried to lower the amount they owe by issuing stocks and have goals of regaining market compliance. Important note that these statements ignore anything that may change depending on the success of the company's goals. Alright, let's look at the debt. These notes or IOUs are generally secured by pretty much everything the company owns. A very common thing. There's a bunch of interest rates on there with various different individuals. They range various different amounts, with a couple going to zero, with debts being fully traded. Some loans have warrant coverage, meaning their debts come with stocks. Here is an example, a loan with companies adding into 4 million, around 2.5 million as of this report's filing. It will be completed by June and has a 12% interest rate. Another loan of 315,000 with a maturity in August, in which they will convert to preferred stock. In total, the company owes 14 million. The company also noted that they marked down debt discount during early mid-2024, which is basically an accounting move to adjust for a debt. Almost 500,000 in stock can be purchased at any time. It's normal for companies to involve closely associated parties. The CFO of the company has also made a payment of $200,000, which is promised to be paid through both cash and warrants. They own a part of Salt Tequila. There is a marketing and distribution agreement with them. Splash can increase ownership. Here are standard costs for their business, including how they may write off leases, some of which are multi-year contracts. Most leases are short. Most of them will expire within the next few years. The company has two pieces, direct beverage segment and e-commerce part with separate staff. The beverage part lost 1.6 million, whereas e-commerce lost roughly 270,000. Company is subject to claims and lawsuits. Nothing big is mentioned here. Their stock does not meet the requirements to stay on the NYSE. This is likely the underlying reason for the previous stock split. Licensing term with Top Out ended in early 2024. Lastly, they added another loan and issued more stock. They have issued 650 shares of A with cash proceeds in late spring 2025. Important warning for the future of reports. Accounting for this can be adjusted at any time. If future events go rough, accounting might change. Lastly, they issued 20,000 preferred stocks and will use stocks to purchase Costa Rica land and all water rights to said Costa Rica land. All that is to say, Splash Beverage Group's financial situation is pretty tough. Looking at the numbers, it shows a company struggling with its debts, while at the same time trying to invest in its own success with acquisitions and long-term plans. They show some improvements in net loss, but revenue and cash flow are still major concerns. The big risk is whether they can turn things around. While their efforts to restructure their debt and make acquisitions are admirable, the fundamental problem of generating revenue and profitability remains urgent. The stock delisting is also a critical item. The Costa Rica water rights could be a game changer, but those kinds of plays are high risk and will require serious capital to develop and distribute. For now, I'd say approach this company with a high level of caution. The risk is just too big to ignore, but the strategy and potential is worth keeping an eye on. And that concludes our analysis. What are your takes? Do you agree or disagree with my view of their ability to execute their plans long time? Drop it down below. And of course, if you found this analysis helpful, hit that like button. We welcome you to join our Discord community so you can stay tuned in real time for whenever new info happens. Thanks for watching. We'll see you in the next Decode.